For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about higher for longer, what today's economy means for your retirement, also why the market won't break, war, AI, and split personality market. What's the magic number to retire comfortably? And then 12 retirement planning questions that everyone should consider. My name's Jeff Shade. I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Jake Floyd at Floyd Financial Group. Good morning, Jake. How you doing today?
I'm doing great, Jeff. Thanks for asking.
Certainly glad to hear that, my friend. Hope everybody else is having a great weekend. We appreciate you joining us here for Show Me the Money. And I think spring has officially arrived here in the Ozarks, Jake. You can feel a little bit more sunshine. Everything is starting to green up. And it's also a time, I think, when a lot of folks are start thinking about what's next, including retirement. So let's talk about that today. I'm looking at the headlines this week, and it feels like we're getting hit from all directions, Jake. Inflation is creeping back. Interest rates are staying high. Markets at highs, but looking a little shaky underneath. Are retirees walking into, well, I guess you could say a trap right now?
Jeff, I don't think so. Again, nobody really knows the answer to that for sure, but I would just say that the fact that there's so much negativity would suggest that a lot of it's already priced in. I think there's a lot of people shaking their heads at why is the market basically back to all-time highs last week when none of the situation's really better than it was. And a lot of it's because the market's just kind of yawning at this news now. There has to be something worse or something bigger for it to be a problem. The market also understands, to use the dreaded T word, that inflation caused by oil prices being up is transitory.
Mm-hmm.
That's true. It's not something that the Fed can really fix by raising interest rates or any kind of policy. It's something that just has to get sorted out. Now, I think that, again, while I have not agreed with many things that Trump has said over the last couple of weeks here, 3 weeks, let's call it, generally speaking, directionally, I think he's still kind of playing 3D chess here, and people don't understand what he's doing. I think before you know it, we will have control of the strait. We will have more business, more countries, more corporations globally buying oil from the U.S. so that they can mitigate this risk in the future. And I think it's really going to be all smiles down the road. However, midterms are not to be underestimated, and I know a lot of people are concerned about that. I'm concerned about it. Again, if Trump puts us to bed in the next few weeks here, I think we'll be fine. If it drags on to midsummer, late summer, early fall, then that could be a different story, and it'll be harder to get rid of the inflation caused by oil in a short order. So I think, again, he has a big incentive to get it down quickly, oil prices, and get this Strait of Hormuz thing cleared up quickly. But I don't think it's all negatives. And we saw big banks start to report earnings this week, and they really weren't talking about the oil prices much. They're just smashing their earnings numbers, raising guidance, and acting like it doesn't exist. And I think that unless it lasts for another several months, that's going to be the case with a lot of industries. Now, this coming week, we have a lot more companies reporting earnings, and we'll get a little more glimpse into how it's affecting them. I assume retail businesses and things are going to start getting hurt. Travel is going to get hurt. But again, I think that the consumer is still strong. And just last night, I was looking at this ad for a new Delta plane that they're building. They're changing the inside cabin for some of their longer flights.
Mm-hmm.
And inside the cabin are these crazy, luxurious, huge cubicles.
Yeah.
I don't even want to ask how much it costs to fly on one of those. It's probably $20,000 or something a ticket for these long flights.
Yeah.
But apparently not everybody's suffering.
Well, that would be my dream on a flight like that, is to have a bedroom where you can just lie down and take a nap. I don't know if I'll ever get to that point. But nevertheless, what you're saying is that what is going on right now maybe should have an effect on people, but it really isn't. Jake, let's continue to talk about this. You had mentioned inflation because we were told this problem was going away, but we're seeing it tick back up around 3% or even a little more than 3%. What's going on there?
Yeah, so I think we're just seeing the oil prices filter in. In fact, that number is kind of less than I was expecting it to be and less than a lot of people were expecting it to be. It's very clear in the data that it's caused by short-term oil prices so far. We'll see if it gets stickier than that in the future and see what happens, but I think it's a little early to sound the alarm bells. I do think that prudence, depending on what your plan for retirement is and where you're at in your plan, taking a little bit of profit here or there, or adding some stability to the portfolio is not an awful idea, especially as we've had a pretty good sized bounce back up here. But I think it's important to keep perspective. When you're looking at the chart of the S&P or your portfolio, make sure you zoom out a little bit. Don't just look at the last 6 weeks. Look at the last 6 years, and you'll notice that this is kind of a blip on the radar so far. It's easy to get short-term memory-itis, and people don't remember what happened last year, let alone what happened last week or last few weeks. During the tariff thing last year, basically a year ago, we were down 21%. So we haven't even been down half that on the worst day. So, and I'm not saying it can't get there, but at the same time, it's important to keep your perspective in mind when you're looking at these crises, I guess, for lack of a better word.
Talking with Jake Floyd, Floyd Financial Group. We're talking about current event headlines here in our program today. 417-889-7233 is our telephone number. If you'd like to come and sit down and talk with Randy or Jake at Floyd Financial Group about how these headlines may or may not affect your retirement journey. Jake, let's talk about interest rates. Kevin Warsh is set to take over in May. Do you think that the Fed is stuck? They can't cut rates yet.
Yeah, so I think that's probably true. I mean, I think they absolutely could cut rates, but I think that they perceive that they can't cut rates. And both the current Fed chair and Secretary Bessent, and I think even Mr. Warsh himself have said that we're not in any big hurry to cut rates in this environment. So the market has basically priced out all rate cuts forever. They're not counting on any more rate cuts, which means that that's not priced into this market anymore, which means if we start to price in rate cuts again at some point, that's probably good for another 5 or 10% out of the market. So we'll have to see how that story unfolds. We got Mr. Warsh going to take over here next month. I got to believe that he and Trump have had a lot of conversation about what Trump wants to see interest rate wise. So I would be very surprised if there was no rate cuts this year. That doesn't mean it can't happen, but I would be very surprised by that because Trump's going to have chosen somebody who's willing to do his bidding. And I don't think Trump thinks that we should keep rates high. I think he thinks they should come down, as he's been saying for years now. So it'll be interesting to watch.
Jake, as you said, the stock market is at all-time highs or near all-time highs. How much longer can this go? I don't really see any cracks in the foundation.
It can go longer than anybody expects. The market can remain irrational longer than you can remain solvent. And what he means by that is it doesn't have to make sense necessarily in the short term. It can look like it's supposed to go down and it can just go up, 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 up. And a lot of that has to do with trader sentiment and what everybody's trading around. There's a lot of things that can move markets. And the answer is it absolutely can go to all-time highs and keep going. And everybody can just be left scratching their heads, which is why it's important to have a plan for these things and not to be knee-jerk reaction-y. I've said the last 4 weeks in a row, basically, that sometimes the right thing to do is sit on your hands. And that's pretty much what we've done here, and it's paid off in a pretty big way. In fact, we've generated a decent amount of alpha. Alpha is, relative outperformance to the broad market just by doing nothing, mostly. And when the market went down, we liquidated a couple of little things. We took some profits on Lockheed Martin and some companies that are defense companies, and we took a little bit of profits on some of the oil companies, but we largely did nothing. And so far, that's paid off. Now, I am always analyzing what's going on, wondering if we're making the right moves and what can we do to tweak this or tweak that to generate some better performance in a down market or better performance in an up market. And I will admit that the risk versus reward is probably not as attractive as it was a year ago or 2 years ago. But that doesn't mean we can't still have a 10 or 15% year here. And I don't think it's time to head for the hills just yet.
Jake, the title of this segment is How Today's News Headlines Are Affecting People's Retirement. Let's talk about the bigger picture here. National debt, Social Security solvency. It all means something to retirees.
Yeah, I think that we're in a mode right now where everybody's afraid of the good times ending. I don't think people are generally feeling the pain too much yet. I do think the dollar is not going as far as it once was. But at the same time, there's a lot of people spending a lot of money, and until that stops, prices are not going to come down. If companies know you're willing to pay $3 for a soda, they're not going to stop charging $3 for a soda.
No.
And they might even try $4 to see if you'll keep paying it. So we're our own worst enemy when it comes to this type of thing. And the convenience and the lifestyle that people are accustomed to living now, they don't want to give up without a fight. So there's a lot of whining going on, but not a lot of changing actions of people. So I think Social Security is here to stay. I do think we're in for a reworking of it over the next few years here, but I don't think it's going to just go away. Now, they may change what it's called or rework how it works, but there's too many people that depend on it. Those people vote, and the Congress people want to get reelected. So I think we can trust in the greed and self-interest of elected officials to carry us on Social Security.
So, Jake, what is the big takeaway of this conversation we've had here for the last 10, 15 minutes or so?
The biggest thing I would say is you need to make sure that you have a plan to deal with these issues that we've been talking about here. And there's a lot of debate as to whether inflation's gone or whether it's not gone, or are safe strategies still safe? Should we be in bonds while interest rates are going up, or should we just focus on income and not worry about the principal? And the answer to all these questions is you really need to plan out ahead of time what you want to have happen with your money, what's important to you, and build a plan that's going to deliver that versus trying to take each issue on its own and trying to trade things around or move in and out of the market all the time, trying to not get your clock cleaned by the next 10% move caused by what's happening on the other side of the world. Having a plan and sticking to it will help you weather a lot of this stuff. So I think that's the biggest takeaway.
And I don't think you retire on a portfolio, Jake. A lot of people think that you retire on income. So if you're within 5 to 10 years of retirement, you're already retired, this is not the time to guess. You need a plan, as Jake said, that answers where your income's coming from, how to adjust for inflation, and how you protect it when the markets turn. Floyd Financial Group, we built a custom retirement income plan for you. We'll show you how to reduce your risk and how to make your money last. You can get your plan by calling 417-889-7233. It's 417-889-7233. Absolutely no cost, no obligation, no judgment. We'll meet you where you are. Ask for your complimentary Floyd Financial Group retirement review today. We would love to talk to you. Jake, time for a break here on Show Me the Money. When we come back, we're going to be talking about why the market won't break, war, AI, and a split personality market when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about why the market won't break.
Jake, I think a lot of listeners are confused right now. We've got a war involving Iran, oil prices spiking, software stocks are getting crushed, and yet the stock market is still hanging in there at near all-time highs. So the big question is, why hasn't the market cracked?
Because these corporations are still making an absolute fortune and they're just printing money. Nvidia, for example, is making $50 billion a quarter clear. So they're just printing money and they're throwing it out of every side and corner. They're like, hey, let's put $2 billion in Intel. Let's put $2 billion in this company. Let's buy $1 billion of this stock, because they can't just sit on it. And the amount of money these corporations are making is so huge. And that's why these stocks won't go away. No amount of bad news matters if the profits still keep rolling in. So until that stops, I think it's going to be hard for markets to really have a big downward move. Now, I was talking with one of my favorite clients yesterday about this. You know, it's been a long time since we've had a real downturn in the market. It's been 18 years since we really had real long-term turmoil. That's a long time. And if you look at history, it usually happens a lot more often than that. So I agree that there are some things to be concerned about, but at the same time, we're living in a little bit different world post-Fed involvement, post-quantitative easing, where the Fed always has their thumb on the scale, keeping us from having these really large drawdowns. Now, I'm not saying we should get complacent about that, but at the same time, the Fed has a lot of firepower to stop any downward move in the economy here, being at 4% interest and having scaled back quantitative easing quite a bit. they got a lot of movement room compared to where we were, let's say, 5 or 6 years ago.
Jake, I have talked to a lot of people who have said, well, I'm not interested in being in the stock market because they equate it to sort of like Vegas or gambling. And I think today's market highs have gotten some people thinking maybe the other way. Is this a time for people who have not been in the stock market to jump into the stock market? Or is the market, do you think, too high? Because, of course, we always want to buy low and sell high.
Yeah, so I think that it's important to not think of the market in that short of time frame, meaning the market's down this week. Is it low enough or should I wait? The problem with waiting is if the market never comes down, you never get in. So again, it seems like I say this about just about everything, but it comes down to the plan that you put together, meaning what is your goal for the money that you're investing? You know, are you 20 years old trying to put a down payment on a house? Are you 65 looking to retire? When you retire, do you have a pension and Social Security to help you, or do you really need to live just off your assets? How much have you saved versus how much money you need? There's a million different factors to think about, and it's just not as simple as, hey, the market's high or the market's low. Just because the market's high doesn't mean it can't go higher. The market's at or near all-time highs like 71% of the weeks over the last 20 years. That's how you go to new highs, is you're at the high all the time. So it doesn't mean that just because we're at highs, we can't go higher. All that being said, I do think there are significant risks out there. And it's important to have a plan for what happens if the market does flip over and go against us. But as far as whether it's a good time to invest, if you have a pile of money you're wanting to invest, I think you go ahead and put a little bit of it to work here. I don't think we jump all in with both feet. And again, this is not blanket advice. It's really going to depend on the purpose of that money. But if I had a pile of money sitting there, I'd be like, hey, let's put a little bit of this to work and let's see what happens over the next few days. If it comes down, we'll put some more to work. But I don't think if you just have a whole bunch of money that's in CDs or something, you don't want to just take it all and dump it all in at one time because you're kind of guessing at where the bottom or the top is.
Jake, I have heard people equate, as I mentioned before, the stock market to gambling in Vegas. Is that a fair equation? I don't think it's really gambling because you can do a little research and hedge your bet. What do you think about that statement? It's like Vegas.
So I think that some people invest like they're gambling. But if you're invested for the long term, you're willing to leave the money alone and not be taking it in and out all the time, not trading over yourself all the time. I don't think it's a lot like gambling, because gambling, you lose your money, right? Ultimately, whenever you gamble, the house, the lottery, whoever it is, has an edge on you. You actually have an edge to the upside on the market. 73% of the years, markets are up on average. And if you zoom out, like I talked about earlier, back to, let's say, 40 years ago, the market's up something like 40 times what it was then. Since 1980, it's up 65 times plus. So it's hard to say that's gambling if all you did was buy and hold and let it sit and you made huge money. So I would just say that I think it's important to employ an investment strategy that is not gambling.
Yeah.
Some people can make money doing that and trading, but if it's your life savings, I don't think that's a great way to do it. We want to have a plan. We want to have an investment that has several buckets of money, probably at least a couple of different buckets of money. So you have a safe bucket and a risk bucket to make sure you're capturing good gains, but you're also not getting wiped out once you start taking income if the stock market takes a turn.
Talking with Jake Floyd, Floyd Financial Group. Once again, our number 417-889-7233. If you'd like to get in and sit down with Randy or Jake and have a one-on-one conversation about your retirement, certainly we can answer any questions for you. No cost, no obligation, and no judgment. Jake, let's shift gears a bit, because while the overall market is holding up, software stocks have been getting crushed. What's going on there?
Yeah, so they've been getting crushed, but they have also been turning around over the last week. Some of what's happening here is short squeezes, right? Where you have hedge funds that have come around and started shorting the stock market. Shorting is where you sell stock you don't own and open a negative stock position. And you can push markets down doing that. However, if markets start to rally and you're short, the way that you close that short position is by buying stock. So it creates more buying pressure in an already upwards move. So I think there's some stocks, some big companies too, Microsoft, Oracle, but also just broadly, the stock market was pretty oversold and a lot of short positions were open. And so I think there's a lot of short covering. That's where they buy to close that short position that's been going on in the last week or so.
Jake, your dad, Randy, has mentioned that AI, at least in his opinion, it's sort of like the Industrial Revolution, that it is that important to the history of America. Would you agree with that? And does AI really present some great opportunities right now that it may not present here in the future?
I think it's impossible to overstate the importance of AI over the next 10 years. Whether you love it or hate it, whether it scares you or you're excited by it, I don't think that AI will be a net positive for humanity. And we could get into a long philosophical discussion about that, but I'll try to keep it to the money. As far as money goes, I think AI will be very good for the stock market. It'll be very good for valuations of companies because they'll have less expense. Less expense equals bigger profit equals higher stock prices. That's a little bit of an oversimplification, but that's going to be coming in, I think, in a bigger way than people are expecting. I think the amount of people that will be displaced is going to be a very large number. How large? My guess is probably 30 or 40 million jobs over the next 5 or 6 years. However, there will also be jobs created, but probably not as many as are lost. So again, what a 20-year-old should be doing is very different than what a 60-year-old or a 70-year-old should be doing here. But if you have money invested, you are likely going to be the beneficiary of AI, whether you're invested directly in it or not, because it's simply going to be rising tide lifts all boats.
Jake, how often do you use AI there in your personal life and in your business?
To be honest, Jeff, I avoid using it as much as possible because I know how crammed down my throat it's going to be in the next 5 or 10 years. So the way we went from not being on the internet to everything was connected to the internet, the way 10 years ago most stuff was not connected via Wi-Fi to everything's connected via Wi-Fi and Bluetooth today, the same thing's going to happen with AI. I'm a little old-fashioned. I like shaking people's hands, talking to people on the phone. I use it here and there for ideas or to look over some things that I'm doing and search for potential mistakes or something like that. But it's really not a big part of what I do at this point. I mean, I could be using it more, but I'm also not sure in the investment field that it's an advantage. And we should probably do a whole segment on that at some point, and I could explain that a little better. But I think we're going to see a lot of people go broke using AI. And I have a reason for believing that, but we'll talk at a later date. But I think it's important to not be too dependent on it. And again, if you think you have a lot of it already, just wait. It's going to be 100 or 1,000 times more over the next 10 years.
Yeah, and I think people need to realize, too, that all the information that you get on AI, ChatGPT, things like that, is not 100% correct. Case in point, I mean, I don't use it as much for business, but for things like, you know, I'm into old cars, so I wanted to check the firing order on my 71 Mustang, and it gave it to me. I wonder why the car didn't run right, and I took it to a guy who said, that's totally wrong. That's for a whole different engine.
And sometimes you'll put something into AI and say, hey, what about this? And it'll spit something out, and you're like,
right,
that's completely wrong. And it goes, oh, you're right. I'm sorry. Here's the real answer. And I'm like, well, what if I was doing brain surgery right now? You know, I'd already cut somebody's brain open. I mean, you know, it's important to understand that it's certainly not flawless. It's incredibly biased.
Right.
No matter what AI you're using, they're all biased. So realize that if there's any political or moral or ethical swing to what you're asking it, realize that you have to consider the source. Who programmed this AI? What do they believe? And realize that you're going to have bias inside the AI. So you have to be careful. You have to account for that anytime you're using it.
Yeah, and I've had some pretty interesting conversations with AI on all of the above subjects there, too. It is rather interesting. You've said before that interest rates are driving everything. How do they factor into this conversation? How important are they right now?
I think they're pretty important. You know, interest rates are up a little bit from the start of this conflict. You know, interest rates were down to like 3.9 on the 10-year Treasury. Now it's 4.2, 4.3. I have to say the fact that the market is held up so well in this environment means that I think it's just raring for an excuse to go higher. That being said, I do think there's some things that are going to limit it in the short term. Some of that is a year, 18 months from now, we're going to have Trump's exit. And whether you love him or hate him, he's probably not going to go quietly back and go down to Florida and just fade into obscurity. So I think that there could be some market implications there. We don't want to get too bulled up, if you will. But at the same time, we need to be careful not to be overly pessimistic, because in a vacuum, meaning no good news, no bad news, the market will churn higher as people fund their 401ks. So you can be scratching your head looking at it and go, why is this going up? Well, because employers haven't stopped funding and employees haven't stopped funding their 401k, which is forced buying at any level. So in a vacuum, the market churns higher. So we want to err to the side of being positive, not to the side of being negative. Some of these talking heads on TV, it's so much easier to be a bull than it is to be a bear, meaning somebody who thinks the market's going to go up as opposed to somebody who thinks it's going to go down. Because on any given year, you have a 73% chance of being right. In a 5-year period, you have a 90% chance of being right. On a 10-year period, you have a 97% chance of being right. So it's much easier just to say, it's going up. How much is it going up? More. And when these guys get asked these questions, they're like, this is the bottom. And then it goes up. And they look like a genius, but they're just counting on people to continue to fund their 401ks and problems to get sorted out, which is generally how it works.
All right, Jake, so let's bring it home for our listeners. What's the big takeaway from this conversation?
Yeah, I think the market has a little bit of a split personality here. On one side, we got war, we got inflation, we got software companies selling off and AI fears. But on the other side, we have very strong earnings. We have AI growth. And even though AI is still in its infancy, it's already changing landscapes. We have relatively stable interest rates given the implications of what's going on around the world. And I do think that as soon as this gets put to bed and oil prices come down a little bit, Mr. Warsh and Trump are going to be lowering interest rates, which is generally good for all business, and we want to be a part of that. So again, I think it's important not to make any really big moves at the moment, meaning we don't want to go too much to the offense or too much to the defense until we learn what's going to happen here as the environment is shifting kind of beneath our feet right now.
Great conversation, Jake. I want to talk to our listeners here for just a moment. Right now, the market is sending some mixed signals. War overseas, tech stocks getting crushed, and interest rates that could change direction at any moment. That is exactly when people make costly mistakes. So if you're within 5 to 10 years of retirement or you're already retired, this is not the time to hope it works out. You need a plan, and at Floyd Financial Group, that's exactly what we're offering you. We'll show you how much risk you're taking, where hidden fees and tax traps could be costing you, and how to turn your savings into reliable income. Call 417-889-7233 right now for your complimentary Floyd Financial Group Retirement Review. Once again, 417-889-7233. You could also request it and find out more about us online at floydfinancialgroup.com. Jake, let's take a break. When we come back, we'll be talking about what's the magic number to retire comfortably when our show continues here on 104.1 FM, KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about what is the magic number to retire comfortably.
And Jake, this is one of the biggest questions in America right now that people have. What's my magic number to retire comfortably? And the answer just went up again. This is according to a survey. We're now hearing numbers like 1.4 million, 2.6 million for high net worth folks. And a lot of people listening right now are thinking, wow, am I way behind? So let's start there. Is there really a magic number, Jake, or is it the wrong way to think about retirement?
The answer is no. There is no real magic number. Now, I will say that everybody has a number, meaning based on what you're willing to save, how long you're willing to work, how frugal you're willing to be in retirement. Those are all factors as to when you can retire. And there's people that retire very early because they don't live on a whole lot or because they inherited a lot of money or other factors. But a lot of it is kind of a trade-off between how much retirement income you want to have and how long you want to work. And I think that there's definitely no magic number that fits everybody. But a lot of it in today's world comes down to health insurance and when you can get Social Security for many people.
Right, and I think the bigger question is how much income can your money produce and will it last rather than how much money you've accumulated. And I think the media loves big numbers, $1 million, $2 million, $3 million, but retirement's not about a lump sum. It is about income. And, let's say people with $1 million, they can have completely different lifestyles and completely different outcomes. Let's talk about that number for a second. I mean, we're seeing $1.4 million average target in America. Of course, we're not average here in Springfield. High net worth people are saying 2.6, and yet the median net worth in America is under $200,000. That is a huge gap. What is going on there?
Yeah, I think this is the difference between hopes and dreams and reality for most people. Now, if you do a good job saving money, you absolutely can amass $1, $2, $3 million without really even that much trouble. It's about being diligent and letting time be your friend. However, most people in this area do not have anywhere near that amount of money. I know people that have virtually no money, but they have $10,000 a month in retirement income because they have a pension, they have Social Security and other things, maybe a couple of pensions, depending on what they did for work. So there's no one size fits all, like we said. But if people really want to retire early, it's about being frugal in retirement because you're already at a disadvantage not having an extra 10 years to save for retirement. So I have a lot of clients that are pretty frugal, and they don't need a whole lot to live on. And that 10 years of their life not working and being able to do what they want to do, as long as their taste is not too expensive, is more important to some people. And then I have people that are like, hey, I don't know why I wouldn't work till 70. I want to make sure I have plenty of income in retirement. But it is important to remember that nobody's guaranteed tomorrow.
And I think the key to success in some place like Springfield or all around the country in more conservative areas is handling money the way that God and Grandma intended us to do it, and that is to spend less than we make. Would you say that that is probably the number one thing that people can do to not run out of money here in the last bastion of sanity is just very simple arithmetic? Is it that simple, do you think?
Yeah, I think some of the problem with the world, Jeff, is nobody can do simple arithmetic anymore.
I know that.
But that aside, I think, yes, that is generally the answer, right? If you are making more than you're spending, you're going to have a surplus. And sometimes I have people come in, they're like, hey, I'm retiring and I need somebody to help manage my money. And I say, okay, great. How much income do you want to have pulled off of here each month? And we'll send you a paycheck. And they said, well, I don't need any income. I'm just going to live on Social Security. And I'm like, really? It's like, oh, yeah, that's plenty of income for me. My mom was raised during the Depression and yada, yada, and we didn't throw anything away, and I could live on $2,000 a month or $2,500 a month. And then I have people that are struggling to make it work on $12,000 a month. And they're like, man, I mean, how are you supposed to buy a car? Trucks are $80,000. I'm like, well, not all trucks are $80,000.
Just most of them.
A new nice truck is $80,000. But I mean,
yeah, of course.
I have lots of clients, though, that drive 10 and 15-year-old vehicles specifically because they don't want to have a $1,200 a month payment in retirement.
Ah.
And so, like most things in life, there are trade-offs. And like most things on this show, it comes down to having a plan. What's important to you? What is it that you want to do in retirement? That's where I would start. I would look at retirement and say, hey, here's what I want to do in retirement. Now, how do I get there? And we build the plan about how to get there. It may not be important to you to go traveling around the world. I suspect a lot of people listening to this show are like, where would I go? I live in America.
Yeah.
I guarantee you that's how I feel.
Yes.
But there are people that want to travel the world, and that's fine, but it does cost money. So you're going to have more money than the guy who's comfortable to drink coffee on the back porch and listen to the cows mooing this time of year and sneezing a few times in the pollen. I think that those two things are not the same. And you need a fraction of the money to do that. It just kind of depends on what's important to you. I think some of that has to do with the career you worked. For me, peace and quiet is all I really want when I'm not working.
Sure.
I don't want to have to worry about a lot of things. Some people, when they go on vacation, that's their chance to worry about everything because their life doesn't have a lot of stress in it day to day. So when they go on vacation, they want to go to all these places. That's the opposite of vacation for me. I would rather just keep working than have a vacation that's so crammed full I can't relax. So again, it doesn't make me right. It's about what's important to you and building the plan so that you get to where you want to go. Not where Jake Floyd says you should go, not where Dave Ramsey says you should go, but what's important to you.
Right, and I think keeping it simple, there's something to be said for that, too. As you said, they're $80,000 pickup trucks, and I had a 73 F100, and I loved that particular truck, too. It got me from here to there, and with a little bit of character. For those people listening right now, Jake, and they're thinking, I am behind. Let's say I'm 62, I want to retire at 66 or 67. I just haven't saved any money. Is it too late to have a comfortable retirement or to plan one that's going to be reasonable?
Well, I think if you still have that 73 F100, it might be worth retirement worth of money if it was in mint condition.
It had a little hole in the floor there in the driver's side, but it gave it character.
It's amazing what some of those trucks go for, though. Some of the old C10 pickups, if they're in good shape,
especially
and all that, man. I mean, it's pretty crazy.
Yeah, the Square GMCs and the Chevy. We're going to get on a car talk thing here, but yeah, you can spend $20,000, $30,000. Mine was basically just a long bed work truck, but I did enjoy it for its simplicity. I've got a '71 Mustang that I drive right now. I enjoy it for its simplicity. So again, it's just whatever makes you happy. You don't need $1 million. You can live on Social Security alone. That is, if you don't need things like hearing aids. I mean, what are they, like $5,000 or $6,000 for a pair of those? And dental work is not necessarily covered by Medicare. That can be pretty expensive too. But I mean, for those people who are listening and they're saying to themselves, boy, I just haven't had a chance to save, is it ever really too late?
I'd say the answer is yes, but most people asking that question are not there yet. Right. If you're 70 and you're still working and you haven't saved anything, it might be too late. I don't know.
Yeah.
But I would just say that short of that, it's generally not too late. There's a lot of people that don't really accumulate any money until they're 55 or 60 and the kids are gone and through college and all that. And then they start accumulating then. Now, that's not ideal, but it is doable. And again, sitting down, having an honest conversation with a professional about what it's going to take to get you where you want to go and what's the best way to get you there, or the most reliable way to get you there, maybe is a better way to say it, that can go a long way. You might be in a lot better shape than you think. When people come in and ask me and have these conversations, most of the time, people are in way better shape than they think they are. So I think it's good to have those conversations, though, and be like, okay, here's where I'm at. How do I get to where I want to go?
Jake, for those people who are a little bit older and they get into retirement, they're on Social Security alone, do you see that many of them take on part-time jobs, not just because they need the money, but because they just can't stop working?
I have a lot of people that get bored in retirement, especially people that have been hardworking. You worked a full-time job and you had cattle and you give all that up and you're used to working 100 hours a week and you go cold turkey to nothing. Most people just can't deal with that. They have to have something going on. So yes, I do have a lot of people that have part-time jobs in retirement, mainly for the sense of community and a reason to get up in the morning and go do something, not so much because they have to financially, but just because they don't know how to stop working, and that work ethic they've had their whole life, they don't want to just get rid of it.
So, Jake, let's get back to this number thing. How do you determine whether someone's going to be okay in retirement? Or in other words, how do you figure out what their number, if there is a number, really is?
Yeah, so basically what we'll do is we'll look at what you need to be spending in retirement. If you don't know the answer to that, we'll take roughly income now, your net income, because you're not going to be funding things like Social Security tax and payroll tax, FICA, Medicare, Medicaid, workers' comp, all that stuff goes away. So you take your net pay, add back in the cost of health insurance, add back in the tax cost. That's a good starting point. That's not the be-all, end-all, but that's what it takes to make it feel like it does now from a spending standpoint. So then we engineer how we get to that income, right? We could reverse engineer. Let's say you need $7,000 a month to be comfortable. We look at what you have retirement savings wise. We look at what Social Security is going to give, any pensions they're going to give, and then we reverse engineer what the shortfall is. The shortfall has to be made up by your investments, and maybe you're already home. Maybe you're already there. Sometimes people come in and say, when can I retire? And I said, why are you still working? And people look at me and they smile, and some of them just can't believe it. But I'm like, hey, you can do it now. Sometimes people come in and they're not quite where they need to be, so we can reverse engineer the math and say, hey, we need to save another $100,000 over the next 5 years. With the help of some growth and things, you need to fund $5,000 or $6,000 a year. Your employer needs to fund it. We need to grow the existing money you have and come up with another $100,000, then you're going to be there. So we can reverse engineer that math to get you where you want to go. But if we never do the planning, it's hard to get to where we want to go. My dad always said, and I thought this is one of the wisest things I've heard him say, and he said a lot of wise things, but he always said, anything you measure will improve. Meaning, if you're a runner and you start measuring how fast you're running, you'll get faster. If you never measure it and you don't know what you're doing, you're never going to get faster, most likely. And the same is true for retirement. If you're not paying attention to where you're at, you're not going to get closer to where you need to be, most likely. So it's good to have a plan, have somebody looking over your shoulder and say, hey, again, it's not my job to control anybody's life, but just to help keep you honest, keep you on course so you get to where you want to go.
So, Jake, if the magic number isn't the answer, what should people be focusing on?
Jeff, like I was saying, we want to have a plan to run on, and it needs to account for certain things. It needs to account for how much income you need, how much health insurance costs you're going to have, how much you're going to pay in taxes, all that kind of thing. And that's what I would focus on, is the plan and executing the plan, not trying to come up with a magic number where, hey, I'm 65, therefore I should be able to retire. That may be true, but that's unfortunately not how it works. And if you need a paycheck out of your investments every month, then we want to really make sure that it's dialed in to what you're going to need, so that when you get to retirement, it really doesn't even feel like retirement except the part where you don't go to work.
Right, and when you get those things right, the magic number becomes a lot less important. So don't change a number, build a plan, call 417-889-7233 and get your complimentary retirement review with Floyd Financial Group today. If you're listening right now and you're wondering, do I actually have enough money to retire? Don't guess. You can find out. At Floyd Financial Group, we'll show you exactly where you stand with a custom retirement income plan. Not a generic number, but a real strategy that answers how much income you can generate, how long your money's going to last, and how to reduce taxes along the way. This could be one of the most important calls that you ever make, so go ahead and make it right now. 417-889-7233 for your complimentary retirement review. Once again, it's 417-889-7233. Leave your name and number. Ashley will call you back and set up a time that is convenient for you. Once again, it's 417-889-7233. Don't hope you're ready. Know you are. Jake, it's time for a break here on Show Me the Money. When we come back, we're going to wrap it up by talking about retirement planning questions everyone should consider when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about retirement planning questions everyone should consider.
And Jake, everybody talks about how much money you need to retire, but what most people don't realize is retirement success really comes down to asking the right questions. And today we're going to walk through a few retirement planning questions everyone should be asking. So let's start here. Why do most people get this concept wrong, do you think?
Jeff, I think a lot of it comes down to people get focused on a number that they think they need to have. $1 million, $500,000, $2 million, whatever number that Joe Bob told them 10 years ago was the right number. They take that number and they focus on that number. Now, whether that number is the right number for them, who knows? And you won't know until you come up with a plan and you sit down and reverse engineer things the way that I talked about in the last segment. But I think that some of it comes from people never feeling like they're going to get there. They have in their head, well, I'm never going to be able to retire. I'm never going to be able to retire. When in reality, some of those people could retire right now. And again, I have more people that fit that bill than I do that have to work another 5 years. When they come see me and they say, hey, is this enough? Here's what I have. Here's what I'm doing. Here's what we spend. Here's what we want to do in retirement. Here's what's important to us. Here's how much we want to leave to the kids, and so on and so forth. Do we have enough? And I will always be honest with those people. Sometimes they don't have enough, but there's a lot of times where they have more than enough. And I get to sit there and be like, well, should I pop the champagne or should we talk about it later? Or, but I get to be the bearer of good news many times. And that's one of my favorite parts of my job, is when somebody comes into me and says, can I retire, or can I retire 2 years from now? I'll be like, I don't know why you'd wait 2 years. It's going to be the best 2 years of your life is the next 2 years if you're over the age of 18. Right? From a health standpoint and other standpoints. So I don't know why you'd wait. And I love being the one that gets to say that.
So Jake, when people come in to you for their consultation and you begin this relationship with Floyd Financial Group, what is the first question that you would ask someone?
The very first question when people come in to see me, if they're looking for retirement, it would be, what do you want your retirement days to look like? What is important to you? Is it spending time with grandkids? Is it traveling the countryside? Is it camping out in the RV at the base of El Capitan, right? In the mountains and all that kind of thing. What is it that makes you tick? What is it that you want to retire so that you actually have time to do? For a lot of people, it's grandkids and things like that. And that doesn't necessarily, it takes some money to spoil your grandkids, right? But it doesn't take the same amount of money as traveling the world. So a lot of people are pleasantly surprised when we really get into the planning process. But that would be the first question, is what's important to you? If you're not here specifically for retirement, you want to come see me just for investments, the question would be, what is the purpose of this money, and when do you want to be able to access it? If you have a chunk of money that your parents left you, you want to invest it, what do you want to spend it on? And if that answer is retirement, then great. But if that answer is, hey, I want to buy a piece of real estate, or I want to buy a really expensive car I've always wanted to treat myself to, or who knows what the answer is, right? I always want to make sure that I'm not assuming that I know the answer, because that's how you get bad plans. If I assume that I know what you want, that's a big mistake. And I think that's probably the biggest mistake most financial advisors make.
And I think that's called lifestyle planning too. We need to know who you are, what your expectations for retirement are before we go to the investments. And most advisors, I think, skip all of that and they go right to the investments. How do we know how much money that you're going to need if you don't tell us what you want to do with that money? All right, Jake, what is the next question that you ask after what do you expect your retirement to look like?
When do you actually want to retire? Is it yesterday? Is it as soon as I possibly can? Some people, that's not the answer. Some people are like, hey, I'm 60. I want to retire at 67. Or I want to retire at 65. Or I want to work till I'm 70. I like to stay busy. And if I'm going to stay busy, I might as well get paid for it. I think the vast majority of people get to a place where they kind of hate their job. However, 20-30% of the population don't hate their job. And they don't dread going to work every day. And some of those people enjoy working well into their 70s in some cases. So again, I want to make sure that I don't assume that I know you want to retire yesterday. However, if that is the answer, then we can work with that. But when do you actually want to retire is a good question.
Right. Average retirement age is in the early 60s, but expectations may vary. As you said, some people may dread their job, but there are other people who actually like going to work as well. And that leads to another big one, Jake. Is early retirement realistic for you? Is that a tough conversation to have sometimes when you sit down and look at the numbers?
To be honest with you, Jeff, most of the time it's not, because people generally have a sense, if they're very underprepared for retirement and don't have a whole lot of money, then they typically know that. They don't come in and go, hey, I think I should be able to take $100,000 a year off of $100,000, right? I mean, most people don't think that, even though, like we said, arithmetic is lost on a lot of the public today. Most of my clients could still count change back to you and all that kind of thing. So they know what's going on. So I don't really have a big issue with that most of the time, but sometimes we have to talk about it and go, okay, I realize you want to retire at 60, but what are you going to do about health insurance? Because if you have decent income and you could retire at 60, your health insurance is going to be like $2,500 a month or something. And it's cost prohibitive. In fact, a whole bunch of people will retire tomorrow between 60 and 65 if they could figure out the health insurance problem. That may be a thing before Trump's even gone here, though. There may be some changes to the health insurance stuff. So we'll have to get through midterms and see what happens. But sometimes, yes, I have to be the bearer of bad news. But a lot of times, these plans and these talks are ongoing. We don't set them and forget them, right? We mold them and shape them and sculpt them as we go through. And so generally speaking, I'm going to see somebody before they retire. And then once they retire, I'll be there to help turn on income. And so that plan's going to evolve a little bit over time. We're not going to change it radically, but there's going to be some things that change in your life. I can't tell you what your retirement's going to look like, but I can promise you it will not be exactly as you envision it in your head. Life will throw you a curveball.
Talking with Jake Floyd of Floyd Financial Group, we're talking about retirement questions that he asks potential clients and that clients ask him. Do people underestimate, Jake, what retirement will actually cost, or do they have a pretty good idea?
Honestly, I'd say it's probably half and half. I have people that think they're going to need more money in retirement because they forget that they're not going to keep funding their retirement plan at 20% a year. And so they come in expecting to need more money than they actually need. That's probably about half the time. And then the other half the time, the opposite assumption is true, where they think, well, I'm not going to need as much in retirement, when in reality, they have more time. So they're going to need at least probably what they're used to bringing home from a net standpoint. And so sometimes people are a little bit surprised that they're going to need as much as they are going to need. Again, if you have saved during your retirement and you have put money away and you've been diligent, you're probably in good shape. If you know that you haven't been started and you haven't saved much, or you had to loot your 401k for health reasons or for a child or for a million reasons that are perfectly acceptable, by the way, but set you back, you probably know that. You're probably not going to come in and be like, well, hey, I looted my 401k last year. Am I ready to retire? Well, probably not. But at the same time, let's get you back on track. There's no use crying over spilled milk. Let's move on. Let's set the plan up. Let's get you back on track, and let's get you to where you want to be.
Jake, let's talk about the amount of money that someone can pull from their savings and, what they put away for retirement. We talk about the 4% rule, and it has been said that you won't run out of money if you only pull 4% with an average investment. Do you think that that is a fair statement, or is it just all over the place depending upon the individual person?
Yeah, the 4% rule always works as long as the market doesn't fall apart, and as long as your plan doesn't fall apart, and as long as you don't have a whole bunch of extra expenses you don't know are coming. So the general rule of thumb is 4 to 5% is a good number to look at, but there's some caveats to the 4% rule, and there are some things that we want to make sure that we're paying attention to make sure that we don't have a big gaping hole at some point because the market decided to turn over on us. Once you get to retirement and you're taking income out, it's very important that we don't have a 20 or 30 or 40% drawdown because it's very hard to get back to even, and that can be your undoing in retirement. So having the right plan, you can maybe even do 5% or maybe even 5.5% withdrawal in retirement. But we need to make sure the plan is in place because even 4% might be too much depending on how we're invested, depending on how we're taking that income, depending on health issues and other factors. But generally, if you want to reverse engineer the math, right? If you want $100,000 a year in retirement income, you need $2 to $2.5 million to produce that. Now, most people don't need that much income in this area, especially after they consider pensions and Social Security. A lot of people need $2,000 or $3,000 a month off their investments, plus Social Security. If it's a couple, of another $3,000 or $4,000. Maybe you have a $1,000 pension from an old job or something, and now you're at $7,000 a month or something. So you don't need to have all your income come from your investments. So you have other sources, but generally speaking, 4 to 5% is a good number to work the math backwards to figure out where you need to be.
Jake, last Wednesday was April 15th. A lot of people filed their taxes. I think most people did file their taxes. If I'm a potential client to you and I'm sitting there and I say, Jake, how big of a factor are taxes going to be for me in retirement? What's your response to that?
My response to that is it depends. So if I'm talking to somebody that is planning to live on $3,000 or $4,000 a month in retirement, it's probably not an issue at all. If you're planning to have $20,000 a month in retirement, it's a big factor, and we need to make sure we're accounting for it. So that is one of 10 or 15 different areas that we'll look at whenever we're kind of putting together a plan for you is, okay, what's the income level? I've been here now nearly 20 years, and more than 20 years, I guess now. Wow, time flies. And as we're looking for, I know kind of what questions to ask based on your situation as it unfolds. So one of the benefits to a financial advisor that's experienced is we don't have to go through all the things that don't apply to you. Why would I focus on taxation when I know it's not going to be an issue for you? Or why would I focus on healthcare if you have TRICARE for life? So instead of handling every tiny issue, allow me to separate what's relevant from what's irrelevant in your situation. And we can really simplify the plan quite a bit instead of making it a 35-page document or something, making it huge and accounting for every tiny detail and many of which don't apply. Let's focus on what matters to you. Let's focus on what's relevant for your situation. And let's keep it as simple as we can. Sometimes I think it probably sounds on this show like it's going to be this really complicated thing that we're going to put together. And that's really not true. I'm going to make it simple for you to understand, and I want to make sure we explain what we're doing so that you have a comfort level with what we're doing, and that'll help you sleep at night once you get retired and not be wringing your hands.
And Jake, if people are hearing the program today and they're realizing I don't have clear answers to any of these questions, that is exactly why we're offering this complimentary retirement review here at Floyd Financial Group. It's about turning uncertainty into clarity and asking the right questions and getting the right answers. So if you would like that, call 417-889-7233. It's not going to cost you a dime. No cost, no obligation. Certainly no judgment. We'll meet you where you are. Once again, that number 417-889-7233. Don't go into retirement with questions. Come in and leave with a plan. Well, Jake, we're out of time for this week. Once again, I want to thank you for your time. But as every week, I want to thank our great listeners for joining us here in the greater Springfield area. So for Jake Floyd, I'm Jeff Shade, wishing you a great weekend. Be sure to join us again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk. The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.